Steve Krouskos rejoins us, Global Vice Chair of Transaction Advisory Services at EY. Steve, really nice to see you.
Nice
Well, why don't you give us the broad brush that you're seeing from this as well, then we can go into a bit more detail.
So the broad brush is this, and perhaps it shouldn't be a surprise. We have seen appetite fall to a 4-year low, with only 46% of the respondents in our capital confidence barometer saying that they will actually do a deal themselves over the next 12 months. Now, why is that? I think, for one, there's been so much activity over the last 12 months, and especially the first 9 months of this year. There's a little bit of a period of pause, catch a breath, and integrate the assets that you've acquired in this pretty robust deal-making period. That's part of it. The other part of it is a lot of the uncertainty that we're seeing, whether it's trade and tariff with Brexit, China, et cetera. And I think some executives are saying, you know what, this is a lot. It's been going on for a long time, and we'd like to take a little bit of a breather and see how it is.
I wonder. I've written down the word disingenuous, not from you, nothing to do with you. It's a big word this time in the morning, but from them, from the executives responding back to you. I don't want to rubbish the whole C-suite and their rationale, but I'm just wondering if it just comes down to what we were previously talking about, money. It comes down to financing as well. They can blame trade wars, they can blame Brexit, but at the end of the day, money's tighter now as well. And when they had free money sloshing around, they had to find something to do with it. Now it's getting a bit tighter. Is it actually the truth that they've just got less money to spend and interest rates are getting higher and cost of financing is getting higher for these deals?
Well, certainly cost of money has gotten a little bit higher, but I don't think it's gotten high enough that it's actually impacting deal appetite. I really don't. I do think, again, more than anything, we've had a lot of activity. You saw this in 2015. We had a big year, then companies took a little bit of a pause to integrate in 2016. We're seeing the same thing. Another interesting data point, by the way, is while 46% plan to do a deal, 90% say they believe the deal market is actually getting better. Whenever we see that kind of a divergence, again, that usually means long-term, we see a lot of health in the market, but we're going to see probably a 6 to 12-month pause in activity.
You also spoken about portfolio optimization, which sort of goes to this trend of this deconglomerization. Speaking of big words, that seems to be happening.
What was that?
Deconglomerization, that's happening on the market.
Deconglomerization. Is that a word?
You don't want to be a conglomerate.
I know exactly what you mean, yeah. But is it a word?
I believe so. I don't think we made it up here in the UK. It was made up somewhere in the States, I think. But effectively stripping out of the different assets. It's a little bit like, is it that card game Gin Rummy where you don't want to be left holding any of the big cards that cost you money? You want to be holding all the slimmed down assets effectively if you've still got a hand of cards. It's like that going into a downturn potentially at some point. No one wants to be holding a bad asset that's going to be disruptive, that's going to cost them a lot of money because it's not making revenue.
So it's exactly right, Karen. This is another reason that I think the market is healthy longer term, because companies are in this active stage of portfolio review right now. Interestingly, 5 years ago, most companies told us that they reviewed their portfolio less frequently than once a year. Now 2/3 are telling us that they review their portfolio more than once a year.
Which is incredibly short term, isn't it?
Well, it just means that you're having to stay on top of all of these impacts around the world. I mean, I just came back from a trip to Asia. I was in China, I was in Japan. You know, you look at the trading companies in Japan, for example. You know, I think you're finally starting to see the trading companies look at their portfolios to assess what should we hold long term, what shouldn't we. 30% of the shareholder base of Japanese public companies now are outside of Japan, or investors outside of Japan. You're seeing this phenomenon all around the world.
So let me ask you a question. Clearly, your company is incentivized to encourage people to sell assets, to be buying and selling and being out there in the marketplace. But is there a risk that companies now are selling assets short term because of the disruption, and they effectively don't want to be in this sort of realm where the assets are not valued properly if they're all part of a big conglomerate? So they shed the assets, but then later on, when the cycle turns, they're then forced to buy back some of the assets because the initial rationale for having those assets actually exists. And perhaps a good one is shipping. Like we've got the Maersk case where originally they held oil, and then you had the big slump in the oil price, so it looked like a bad asset to be holding, so they sold it. Then you had a big spike in the oil price, so it made sense possibly to be holding oil again down the track to smooth over some of the earnings and the cost base. I mean, are we in a risk that companies are now being forced to sell companies that they should really be holding for the long term?
So I think the risk that you just outlined is the reason that we're seeing companies stay private longer. I think it's the reason reason we're seeing private capital become a bigger player in the market. I think it's a reason that the public markets are less attractive maybe than they were 5 years ago. I believe the businesses that companies are selling are not for short-term reasons. It's because disruption, technological disruption, is causing them to see a long-term change in their business model and the need to align different elements of the supply chain. In fact, some of the companies that we're seeing that are doing acquisitions or plan to do acquisitions is actually to combat supply chain issues that they see coming from some of these trade and tariff changes.
Perfect. Thank you very much indeed for giving us the latest strange deconglomeration. Yes. Whew. That's 16 letters too many for me this time of morning. Steve Krouskos, thank you very much indeed for that. Global Vice Chair of Transaction Advisory Services at EY.